Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you joining me here on the East Coast. It's just after 12 noon Eastern Time. We'll say good morning to those of you joining us from the Central Time Zones, the Mountain Time Zones, or the Pacific Time Zones. And of course, good evening if any of you are joining us from across the pond in the parts of UK or parts of Europe. Now, in today's presentation, we're going to discuss the initial setup of a radioactive trade, what's taught in the free white paper, the sketch, as well as what's taught in the blueprint itself for the initial setup. We're going to review the three core principles of radioactive trading, but essentially any trade as well. Why are we using this setup? Why do we set it up the way that we do? Well, that's perfectly reflected in the three core principles. But then we're going to discuss the trade comparisons that are most commonly discussed during webinars, questions that come in from the post-webinars, or emails that come in as well. And we're going to show you some real-world where are we now examples comparing the comparison trades of potentially getting into a position that's a parity or similar to a radioactive trade or trying to mimic a radioactive trade at a cheaper cost. And then we're going to handle a few roundup questions. So, first, I just want to introduce some of the basic concepts to those of you who maybe you're just attending a radioactive trading webinar for the first or second time. The radioactive trading techniques are a unique trading style developed by Kurt Frankenberg. The idea of a radioactive trade is to focus on limiting risk first. And Kurt came up with these concepts a little bit over 12 years ago, after he had taken a weekend course to learn how to do covered calls and spread trades. And he had spent a couple $1,000s to attend the seminar, and he spent a couple $1,000s to get a sort of proprietary trade selection software that would show you green, red, and yellow arrows to buy or to sell or to hold kind of thing. And then he followed his guru's advice, and after about the first 60 days or so, he essentially lost everything he had set aside to trade. Okay, taking leverage losses on the spread trades and doing something I would never suggest to anyone, even if you wanted to trade covered calls or other strategies. But he followed his guru's advice and he essentially got burned. Well, he didn't give up. He realized that the money that he had lost didn't just disappear. It went somewhere in the market. So what Kurt decided to do is focus on a trading setup that would focus on limiting risk first, but leaving the upside open. Now, over the years, the blueprint also discusses the 12 different adjustments, or what we call income methods, that we use to reduce the risk of the initial position, bulletproof the trades, and potentially profit in either direction. And the concept of the setup is to cut the losers short and allow our winners to run. Now, for those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. Power Options is a patented suite of search and analysis tools designed for self-directed options investors, and we do support over 23 of the most commonly used option strategies here at Power Options, and I've traded many of them. But for the past about 8 years or so, it says 5 years ago, but it was back in 2007 when I was introduced to Kurt. So the past 8 or 9 years, at any given time, 50 to 60% of my trading accounts has been in the radioactive trades. Okay? And the reason why I'm doing that is we've had more success. I've personally had more success long-term trading these techniques over covered calls, naked puts, calendar spreads, trying to do a portfolio of credit or debit spreads, and even just buying calls and buying puts. And we'll see why in just a little bit. Now, the initial setup of a radioactive trade. Anytime I open a new position following these techniques, the initial trade is a unique form of a married put, or what you might know as a protected put position. We're going to buy stock and buy a put option, but rather than buying an out-of-the-money near-term put option for a cheap price, so if I bought a stock at 50, a standard protective put may be to buy a November 45 put for 80 cents or so. What we look to do is buy a stock and buy an in-the-money put that's at least 5 months out in time. Now, that might look expensive and might seem expensive, but it takes advantage of the three core principles. Now, the initial setup is a bullish position. I'm expecting the stock to move up in price. There are ways to play it in a bearish market as well if you have a bearish sentiment, and that's talked about in the blueprint as well. So let's go back to August 9th, 2016. At the time, I could have bought 100 shares or maybe even 200 shares of Foot Locker for a price of $58.32. At the same time, I would have bought a January 2016 or 2017 60 strike put for $5.30. Now, as I mentioned, this might look expensive to some of you. I'm paying almost 1/10 the price of the underlying stock for this far out, slightly in the money put. My total cost would increase to $63.62. But remember, buying that put option guarantees that at any time between now and January expiration, I can force someone to buy my shares of stock at 60. I have a guaranteed exit, which is much better than a stop order. If the stock gaps down 33% due to earnings or some other event, I still have the right to close it at 60. Or if I just use a stop order, let's say at 55, and the stock gapped down to 50, well, that stop order would have been triggered, but I would have gotten out of the stock at $50, whatever the market's offering. The market can no longer give me 55. Here I have a guaranteed exit even in the worst case scenario. So my total risk is $362, not the price I paid for the put. This put option consists of two things. It consists of time value and intrinsic value. So all I'm risking when I open the position is the time value. So this $1.68 in the money, the intrinsic value, is not at risk, just the time value. So this setup means that yes, I'm investing for 100 shares $6,362, but in the worst case scenario, I can only lose 5.7% of my investment into the position. Okay, well, here's a profit and loss chart of what that Foot Locker position would have been. Now, the total investment is $63.62. And you can say, well, you're not going to make a dime until the stock hits $63.62. Well, that might be true. If I hold the position all the way to January expiration, I choose to make no adjustments on the position, and I choose to accept no dividends if a dividend is paid. The curved red line here shows us the profit and loss at the halfway point. So we see even if the stock was trading just at 61, we'd have a profit. Why? The put does not decay one-to-one with the stock. I'm not $3.62 behind the 8 ball when I first open this position. In fact, the moment I open this position, all I'm losing is the bid-ask spread of the put option. I could have turned around and sold to close my stock at $58.32 and sold to close the put for maybe $5.20 or $5.25 and just would have lost the bid-ask spread and commissions. So we have a position here we can still take advantage of infinite upside, but we have a controlled single-digit risk to the downside even in the worst-case scenario. Now, the three core principles of radioactive trading. Well, number one is what we call FIST, forcing an ideal size trade. This position that I just showed would cause me to put up $6,362 if I purchased 100 shares in one put. But we can get a similar risk-reward profile by using another strategy we're going to take a look at in just a few moments, but that position uses leverage where I can fall into the trap of overtrading and increase my losses exponentially if I'm not careful and I don't force myself into a proper ideal size trade. Every position that we open saves us from overtrading using the radioactive techniques, and also there are other concepts we use to force a proper position size. That monetary risk of $3.62, if I open that position, I would make sure that the monetary risk is maybe between 1% and 2% of my total portfolio value. So if I had a portfolio size of $35,000, I'd only open 100 shares in one put. So that entire position that cost $6,300, in the worst case scenario, could only lose $362, or about 1.1% of my total portfolio. And if I had a $75,000 portfolio size, I might open 300 shares and 3 puts so that the total monetary risk would still be between 1% or 2%. Now, the second core principle is the at-the-money bell curve. Anytime you look at any option chain, you'll see the highest time value is always going to be at the call or the put strike that is closest to the underlying stock price. What does this teach us? Well, it teaches us when we're selling, if you're doing covered calls, or maybe you're doing credit spreads or debit spreads, even calendar spreads, you want to sell the option that is closest to the stock price to maximize the time premium, a true profit as options investors. But when you're buying, you typically want to buy an option that is in or out of the money to pay the lower time premium. Okay? And that's if you're buying speculating on a market movement in one direction or the other, maybe due to earnings or some other upcoming event, or if you're buying insurance. And finally, what Kurt calls the red line, the radioactive decay line, or simply the time decay line. Options that are farther out in time tend to decay more slowly. That's why the benefit of selling premium in strategies are really enhanced by the weekly options. So you can sell week by week or sell month by month, and you get a better annualized return, assuming everything works out correctly. But when you're buying premium, the option that is 5 or 6 months out in time is not going to be 5 or 6 times the cost, and the decay is going to be much more slow. So that is why, sorry, I just didn't see that typo there. I don't know why that didn't come through, but the at-the-money bell curve. Anytime you look at an option chain, you'll see the swelling of the time premium at the money, closest to the current stock price. Where your out-of-the-money calls, the higher strike calls, and the in-the-money puts will have a lower time value. And of course, you go lower strike prices, the in-the-money calls or out-of-the-money puts will have the lower time premium. So in radioactive trading, why do we buy the in-the-money put? Well, it's to take advantage of the lower time value. And you might say, well, if you bought Foot Locker at 58.32, why didn't you buy a 55 or a 52.5 put with a lower time value and cheaper cost? Well, because the put is an insurance policy, but it's also a second asset that we can manipulate on our shares of stock. If I buy a lower strike put, the stock has to fall $3, $4, $5, or $6 before that policy kicks in. And then I still have to cover the payment of maybe only $1 or $2 as opposed to the $5.30. Buying the in-the-money put, we've already have the insurance started, and if the stock falls, our put increases in value, counters a large amount of the loss we're taking on the stock. That again, the proper position sizing. That's why we use the in-the-money puts, even though the out-of-the-money puts have lower time value as well. Now here's just your simple picture of the red line, radioactive decay line. As we know, if we're selling options that are 7, 15, 30 days out in time, we expect to see that rapid time decay in our favor. Okay, we want to see that time, especially over the weekends, for example, maybe get 2 free days. But we can see here how that increases exponentially as we get closer to expiration. Whereas if I'm buying for speculation or for insurance, and I buy 150 days out, the first 30 days we have a slow amount of time decay, and then the next 30 days even slower, and so on and so forth until we get to the end. So I want to be buying over here and selling over here to put the time value and the time decay in my favor. Now, we've talked about how these are the 3 core principles we look at radioactive trading. But it's really the same 3 core principles you look at any option strategy. You're doing covered calls, you know you can get a higher premium selling 4 or 5 months out in time. But you're going to get a better annualized return selling month by month by month. But of course, covered calls doesn't give you that guaranteed risk protection to the downside. If your stock falls 33 or 40% from some unexpected event, you're still on the hook of 97% of the risk you would have had in a long stock position. Credit spreads as well. Most of you trading credit spreads are probably looking at a 14, 15, or 7-day out time frame, maybe even 30 depending on the security you're looking for. But when we're buying an option for a calendar spread, we're buying for speculation, we want to be buying out here so the time decay is not as rapid. All right, let's get into our trade comparisons. I showed you how I would have set up a radioactive trade on Foot Locker on August 9th. That setup consists of two basic components, being long the stock, paying the money to own the stock outright, and buying a far out in time put option that is slightly in the money, so we force ourselves to follow those three core principles. Okay? Now, a lot of people who look at this say, why would you add a bearish instrument to a bullish trade? If the stock goes up, your put's going to lose, and the stock's going to gain. Well, the stock, with proper structure, talked about in the blueprint, the put does not lose one-to-one with the stock. But for those of you doing covered calls, think about it. You're doing the same thing. You buy a stock, it's a bullish strategy. Selling a call by itself, a naked call, is probably the most bearish thing that you can do because it takes infinite risk to the upside. But in combination, you get a better setup. Okay? But the main comparison, the main questions, anyone who's seen one of these webinars, maybe you even own the blueprint and you've thought about this, we're options traders. We've been taught that there's better ways to trade, that you can get 200 and 300% gains by buying call options or using leverage. Aren't there cheaper ways to own a stock or to mimic stock ownership rather than buying it outright? We all naturally want to pay less money. We all want to get the great deal. But are the trade comparisons really a better trade? Let's take a look. Now, the first discussion that usually comes up is, why buy the stock outright? You can get stock at a cheaper price by selling a put option right now and collecting the premium. Okay? Many investors use this technique to get into stocks at a cheaper price. You collect the premium up front. If the stock falls below your put strike price that you sold, you may be forced to buy shares of stock at that lower strike, and you keep the premium. Now, by itself, an out-of-the-money naked put trade, cash-secured naked put trade, is a parity trade to an in-the-money covered call position. And investors naturally use it to generate income or to potentially get into stock at a discount. So back on August 9th, with Foot Locker trading at 58.32, I could have sold to open the August expiration 57.5 put for 105. The maximum profit, if the stock stays above 57.5 and my put expires, would be 105, or roughly 1.8%. What is that based on? Well, the 1.8% is based on the cash secured value I might have to have on hold in my account in order to buy the stock. Okay, my obligation is that I may have to buy shares of stock at 57.50. My broker may require me to have that on hold in my account. Okay, so the 1.8% is the 105 divided by the potential obligation at 57.50. Now, if the stock was trading below 57.50, I still keep the 105. So I'd have a cost basis of 56.45 rather than buying the stock at 58.32. Okay, well, what is the downside to the cash secured naked put? Well, it's the same as a covered call. If you're wrong on the direction of the stock and the stock falls to, let's say, $50 per share, we're still risking pretty much about 98 or 97% of what we would have if we'd bought the stock and it fell 33 or 40%. We've only reduced our cost basis by about 2% or so. Same with the covered call. The other problem is that you have a capped upside. If the stock went up to $67 or $68 per share, we don't make any more than that original premium. Okay, but regarding the downside, you're using it as a comparison against what I do with a radioactive trade. That's perfectly fine. So instead of simply selling your put option for 105, maybe you're considering using that as a means to get into the stock at the lower price, 56.45 if it works out in your favor, and already having the put that I have in place for protection. So you might set up what we'd consider a calendar put spread to mimic the stock ownership to get in at a cheaper price but still have the insurance in place. We'd sell to open that 57.5 put for 105, and we'd buy the January 60 put at 5.30. Well, now your total cost into the position is only $425 per contract. So if you did one contract, it'd be $425, as opposed to, remember, my entry was $6,362. Okay, and you have the opportunity to potentially own shares of stock at a cost basis of $56.45. Okay, well, this seems great in theory. you get in at a lower price. You have a much less cost basis into the position as to what I did to the radioactive trade. But what are the downfalls? Well, the downfalls are that you now have two ways to lose. If the stock collapses, you could still lose to the downside. And remember, your maximum risk is 425. Okay, mine was 362, so you have a higher risk, of course. You have a profit, a potential locked-in profit of 112, but that's if and only if the stock's trading right at your put strike price at expiration. And that would be a 26.4% return off of your total investment of 425, okay? But remember what I said about the radioactive trade. I would have opened that position with the hope, with the research and analysis, that I feel Foot Locker had the potential to move up, let's say, 4 to 7% within the next 20 to 45 days or so. Trying to get into the position at a lower price, generating premium right away, gives you two ways to lose in the direction you originally thought the stock was going to go, and of course to the downside as well. Now earlier we saw that simple profit and loss chart of the married put, with a risk of about 362 down here, okay, and the infinite upside. And you might have thought, well, why are you trading against yourself? You're bullish on the stock, but you bought a bearish instrument. Well, it's because I set up a structure where I could only lose single digits in the worst case scenario and had infinite upside profit potential if the stock really took off. I don't consider that trading against myself. I consider that insuring my investment. This profit and loss chart is in fact trading against yourself. By trying to get in at a better price, you of course run the risk of suffering larger percentage losses to the upside if the stock moves up in the direction you thought it was going to originally. Okay, so I opened a bullish position. This is not a bullish profit and loss chart. The difficulties with trying to use the calendar put setup to mimic or substitute for radioactive trade is you're trying to time your trade. You're saying that in the next 20 to 30 days or so, the stock's not going to be trading more than plus or minus 1% above 57.5, and you're going to be able to buy the shares of stock at a discount or resell a put later on. Okay, you're really trying to force to time your trades. And at radioactive trading, we follow one of the sayings that Kurt uses is don't time your trades, trade time, which is why we have that insurance in place. In order to be successful long term, you can already see by that risk-reward profile, you need the stock to be trading right at just above or just below the put strike price at expiration. If the stock goes up as your original expectation for the position was, you can suffer larger losses. And what you may have to do, in that example we just saw, if Foot Locker started to move up to $60 or $61 per share, you're going to have to scramble to buy the stock, because if you let it go too far, and you buy it at $64 or $65 per share, you're going to have a married put with a much higher risk, even with the 105 you collected, because you're losing delta to the upside, which I still have advantage of with the radioactive trade. Okay, so just a simple side-by-side comparison. The radioactive trade we had a maximum risk of only 362, or 5.7% of what I invested. The calendar put's going to risk slightly more, but remember, you're risking 100%. And I'm forced into an ideal size trade where that position would only risk 1 or 1.5% of my total portfolio value. The problem with the calendar put is you're using leverage. You might not open one put, sell to open one put, and buy to open one put. Now that your cost is only $425, you might find yourself wanting to do 5 contracts. Well, now your risk is increasing up to the $2,000 range, where I'm still risking $362. So you risk over trading due to the lie of leverage. The radioactive trade is unlimited upside. The calendar put gives you a capped gain to start and the potential to lose in 2 different directions if the stock moves up as you expected or the stock falls in price as we saw. Now, can you use this to get into radioactive trades? Let's go back to the profit and loss chart. My answer to that question that comes in is, well, sure. If you want to try to mimic radioactive positions by using this to get into positions cheaper, you can. But What you're going to have to do, honestly, is you're going to have to consistently pick positions where the stock does not move up or down more than about 1% or so in the first 20 to 30 days of the trade, and then in the following 2 to 3 months after that, it moves up 5 to 8%. If you can consistently pick stocks that do this, and I'm talking about to the tune of 70 to 75% of the time, this might work out for you. But if you can consistently pick stocks on a regular basis 75% of the time that don't move plus or minus 1% in the first 30 days and then move up 5 to 8% in the following 60 days after that, you really don't need my help. You're going to be doing just fine in your stock selection and your options trades without me assisting you. Okay? That's why the calendar put doesn't work long term as a comparison to opening the RadioActive trade and paying the price to do it. All right. Review again. We know our 5-line setup from our footlocker position. The second comparison, very common one. Why buy the stock at all? You're using a put. I get it. You're using a put to ensure the positions, but investors who have smaller accounts or investors who are promised 300, 400, or 500% returns, they don't want to buy stock. I know that. Okay, so how do we mimic stock ownership? Well, instead of buying the stock, why don't I buy a call? To mimic stock ownership, I'll buy an in-the-money long call with maybe a higher delta so that I get a reasonable return if the stock moves up as I expect. It's a lower cost. I'm only paying maybe 1/10 or less of what I would pay to own the stock, and I'm still going to see a leveraged gain on the call position. So why buy the stock? Why not substitute a long call for the stock and keep the same put and do better than the RadioActive trade? Okay, well, this would create what's called an in-the-money long strangle. The in-the-money long strangle is a combination of, well, a long strangle by itself around earnings. We did a webinar a couple weeks ago on that at Power Options, straddles and strangles for earnings, but most investors would look to buy a cheap out-of-the-money call and a cheap out-of-the-money put option to enter a strangle or a straddle, well, strangle really, going into earnings. But if we're substituting stock with an in-the-money long call and we combine it with the in-the-money long put we would have already owned, we create an in-the-money long strangle. This does give us a similar position to a strangle itself, where we'd have infinite profit to the upside and the downside, well, to zero, but the risk is the cost of the time value for both options. Very quick, Jeff just came in and said, I arrived late. Will a replay be available? Yes, I am recording this presentation. Should be available by around 4:30 p.m. or 5 p.m. Eastern time this afternoon, Jeff. We'll send everyone an email when the webinar has been posted. Okay? All right. So a comparison. If I was to open an in-the-money long strangle on footlocker, the stock 58.32 on August 9th, well, we would have bought our January 2017 60 put at 5.30, same put I used for the RadioActive trade. Now, this put at the time was 2.8% in the money. The 5.7% time premium, which is my risk on the married put trade, and had a delta of about 0.55. All right, we want to use a slightly more in-the-money call option to get a higher delta. So on August 9th against footlocker, I might have bought the January 50 call for $9.70. The stock's at 58.32. Okay, so there's a time value there of about, we're 8.32 in the money, so $1.70 there. So let's call it $1.40 or $1.38. Okay, $1.38 a time premium. But this call option is 14.3% of the money, almost 15% in the money. Only has a time value of 1.9%. We're carrying a delta of pretty much close to 0.8. Now my total invested into the position is $15. But unlike an out-of-the-money long strangle, the in-the-money long strangle, this is not my true risk, right? Because my strikes are 10 points apart. If the stock is trading right at 55, halfway between, my put would have $5 of intrinsic value. My call would have $5 of intrinsic value, so I'd get 10 points back. So the true risk on the in-the-money long strangle is only $5. Well, it's $1.40 higher on the monetary risk of what I had with the married put, but we're risking 33.3% of what we paid into the position if we take the maximum loss. Why is that important? Well, one of the reasons why I set up a radioactive trade the way we do is I want to keep the risk, in that single-digit range, under 8% or so, really at around 5, 6, 7%. If you take a 33.3% loss on a position, you don't need a 10% gain, or I'm sorry, a 33% gain on your next trade to get back to break even. You need a 50% gain. Okay? And, if I take a 25% loss on a position, I need a 33% gain to get back to break even. Of course, if you need to take a 50% loss, you need a 100% gain to get back to break even. But if I take a 5% loss on any position, because I've set up the proper structure, I only need to make about 5.3% to get back to break even. So we're stacking the market odds in our favor. Again, proper position sizing and forcing an ideal size trade. This is not forcing an ideal size trade. But let's take a look at the profit and loss chart. Would an in-the-money long strangle give me the opportunity to benefit or profit in either direction? Yes, I still have the infinite upside that we had with the married put position. And I have a potential to profit on the downside if the stock gaps down. But the break-evens are fairly wide. It's a 20-point, 45 to 65 break-even with the in-the-money long strangle. And we already talked about the issues with taking too high of a percentage at risk on the position. Okay, but here's our profit and loss chart for that in-the-money long strangle if we opened it on August 9th. Now, the difficulties with using this position against a radioactive trade instead of a radioactive trade. I've run several examples of this for investors over the past 6 or 7 years, comparing what would it look like on stock A or stock B if I did this. Well, what are the difficulties with the strangle? Your monetary max risk and the percentage at risk is going to increase drastically due to buying into 2 time premiums. You start off the position delta opposed, not delta neutral. You're delta opposed, which means you need a much larger movement in one direction or the other, but even to the upside to realize a profit. Lower capital again is used. You're using leverage, but the lie of leverage kicks in because you may run that risk for overtrading if you're not disciplined. Every example that I've run in normal market conditions, to the upside, if we just assume a stock making a 2, 3, or 4% gain in a 20-day or 30-day period, the radioactive trade realizes a profit or has an unrealized profit long before the in-the-money long strangle sees a gain. Okay? Again, the side-by-side comparison, the risk on the married put is only 5.7%. With the in-the-money strangle, you're entering that lie of leverage. You're going to see 30, 35% risks on your investment. You're going to risk overtrading due to the lie of leverage, and you start off with a delta opposed position, not delta neutral. You're delta opposed. So you need that much larger movement in one direction or the other in order to realize a profit. Okay? Now, the big detraction, most common thought that we see, and that's perfectly fine. Someone looks at a radioactive setup, such as I did on Foot Locker, and you just look at the profit and loss chart. You see the setup is the same as buying a far out of the money long call, but the out of the money long call is better. How can something be the same but better? And that doesn't work grammatically. But the idea behind it is the risk-reward profile is the same. That's not what I'm arguing. I'm arguing that the structure of the trade is not the same. The out-of-the-money long call is not a parity trade to a married put position. Now again, let's take a look at the married put. I would have bought stock at 58.32, and at the same time on August 9th, I would have bought a January 60 put for 5.30. My total invested, $63.62, but I'm guaranteed to get 60 back, so my monetary risk is only $3.62. Well, the long call, the quote-unquote parity trade, buying the out-of-the-money long call, with Foot Locker trading at 58.32 on August 9th, we could have purchased a January 60 call for $3.55. We know the max profit is infinite as the stock moves up, and the max loss is $3.55, but it's 100% of what I invest into the trade. Now, the long call would have lowered the risk by 7 cents. My risk was $3.62. This long call is $3.55. So this must be a superior trade. Well, you take a look at the positions there. Well, here would be the profit and loss chart of the long call. It's almost the exact same thing that we'd see with a radioactive trade. You have infinite upside. The true risk of $3.55 would probably only occur if we held this call all the way to January 2017 expiration, made no adjustments on the position, and the stock was trading below 60. Of course, that's the same thing with the married put. That $3.62 loss, I'm probably only going to realize if I hold the position all the way to January expiration, I make no adjustments, and the stock's trading below my put strike price. Okay, so the risk-reward profile is similar, but what's not similar is the amount we're risking, and you're not forcing an ideal size trade. Okay, these are not parity trades of one another. The problem comes with the discipline, is proper money management and forcing an ideal size trade. That long call, you're going to risk 100% of what you'd pay into the long call as a quote-unquote parity trade to the radioactive or married put setup. But you're going to say, Mike, the investment was only $3.55. I agree, but is that what you're going to do? Okay, let's say you and I had similar accounts. I'm on the account here in left, okay? So this is me, and this is you, okay? And I'll just go YOU. All right. So we both have accounts of around $100,000 total, with some positions open and things and obligations maybe to spread trades and margin requirements, but total account value around $100,000. We're both sitting on $15,000 of free capital to invest in a new position. I open a radioactive trade on Foot Locker on August 9th. The stock plus put combination was 63.62, and that would risk 362 or 5.7%. Now with my 15K of free capital, I might buy 200 shares of the stock and 2 puts. So it would put my cost basis at $12,724. But remember, I'm only risking double this, $724, which is less than 1% of my total portfolio value, and it's still only 5.7% of the $12,000 I invested. You see me open this trade, and you say, I want to use the call. So you go ahead and look at the call there. The January 60 call is at $3.55, and you're risking 100%. Well, you can buy up to 42 contracts of the 60 call, which means you're investing $14,910 for the same risk-reward profile that I have, but your total risk is $14,910, what you invest in the position, or 14.9% of your total portfolio value. Okay? Now, I'm exaggerating to illustrate the concern. I know you would not use that full free investment of $15,000 to buy 42 contracts. I know that. At least I hope I know that. Okay? But let's be honest about the nature of the investor, and especially anyone or any investor that wants to use leverage to try to get the quote-unquote more bang for your buck. Let's say that you saw me open that position, maybe in the Fusion subscription where we post our trades for our Fusion subscribers, and you're disciplined to only buy 2 contracts of that January 60 call at $3.55. So you've got an investment of about $710. But what are you going to do with the remaining $14,290 of free capital? Are you going to put that on hold in your accounts, sort of as reserve cash, or are you going to buy 5 calls of stock XYZ, 5 puts on stock ABC, 10 calls or puts on stock 1, 2, 3? You're going to start investing into other positions, which means bullish or bearish, you've got more of your portfolio at risk on these multiple positions. Okay? If you're going to tell me that a long call is the same as a married put position, there's only one way that works. If I buy 200 shares of Foot Locker and 2 puts, I've invested $12,724. I'm risking $724, 5.7%, and whatever comes out to be less than 1% of my total portfolio value. You buy 2 January 60 calls at $3.55. a total cost of 710. You're risking 100% of that, but that's still less than 1% of your portfolio. If and only if you leave the remaining $14,290 of your $15,000 of free capital on hold in your account and make no other trades until you close this position. This is the only thing that is a true parity to the married put. Just buying a call by itself is not, unless you leave the amount of money on hold that you would most likely use to buy the shares of stock in your account and you don't enter other trades. That's the true parity trade. By itself, a long call is not a parity trade to the married put. Okay? All right, before we go into this next slide, what's the use of talking about all these comparisons without kind of looking at something else? Okay, what do I mean by something else? I mean, where would things stand right now? I'm going to navigate over to Power Options real quick, and we just want to take a look at some of these positions, okay? And one of the things, I might contradict myself here, but that's perfectly fine. First, here would be our long call that we would have opened on Foot Locker on August 9th. The long put position is just by itself there. I'll explain why in a moment. And then, of course, we have the married put, and here's our in-the-money long strangle. Now, the stock itself is up 15% from when we got in the position, with doing no adjustments, no income methods. By the way, where I stand on Foot Locker right now is the put option that we have gives us a guaranteed exit of 7%. It's a bulletproof position with a guaranteed 7% profit and still an infinite upside potential going into earnings in the next 20 days or so. But let's ignore that. The stock's currently at bouncing around $67 this morning. So we have a gain. The stock has moved up about $8.65, $8.67 from our original purchase price. Now, with the married put, we own the stock, so we've got that locked-in gain of $8.65. We did lose $4.20 on the put option. Okay, so what does that mean? Right now, our liquidation value on just the married put is $445, or 7%. The long put I'm showing here, this is the calendar put, but taking into account the position, the put option has dropped to 110. So if we've lost 420, we would have gained 105 for August and another 105 for September, but this is still at a loss of about $200 on the position because the stock moved up. So the idea of the calendar put being a superior trade is thrown out of the window because the stock did exactly what we wanted to. It moved up more than we expected over the first 70 days of the trade. Well, you know, close to it, but that's the case. The calendar put would have been a loss. Would we have profited, made a profit on that in-the-money long strangle buying the January 50 call and the 50 put? Yeah, we have a gain of $830 on that 50 strike call we would have purchased and a loss of $420. So we've gained $410 with a gain of 15% on the stock. That's important, you know, 15% gain. But we would have gained $410. Well, it's a high leverage gain, but it's less monetarily than the married put position. So bang for the buck. Is it money you want back versus money you invest? Is it percentage return? And let's be honest, with this type of gain, the good comparisons, the in-the-money long strangle and the long call, are going to have a good profit. And of course, the long call here we see as a monetary profit and percentage profit much higher percentage-wise than the married put. I agree. But if you had opened 5 other positions and they fell in price, would you and I have been at parity on this position even though you have a 470 gain? No, I've got a 445 gain. You know, just about $35 less than you here, $25 less than you. But of course, the lie of leverage works both ways. Here I'm in a position where I've made 7% on the married put. You've made 132% on the long call. But what about those other long calls you would have bought with the remaining $14,000 on the position? Okay, but what about a different real-world example, meaning something that didn't quite move 15% in price over the last 70 days? And of course, I understand. No one's mentioned it yet, but I know it's on your mind. All three of us, all four positions, if we had four different investors do all four positions, we all would have adjusted these as the stock started to move up. Maybe you would have held the long call if you just expected more and more bullish position. The stock did go above 70 at one point. You might have closed at that point and taken the gain. But we would have adjusted all these positions to try to lock in some of the unrealized gains. But this is just the comparison, side by side with no adjustments, no income methods, anything involved. But let's take a look at something a little different. Something, I don't want to say more realistic, but something more common that you and I might see on a day-to-day basis or month-to-month basis, for example. About a week ago, maybe 2 weeks ago, I did a webinar titled Don't Be a Victim of Market Indecision, showing you the comparisons of different ways to manage a long stock position that has an unrealized gain. Do you sell half? Do you sell a covered call to generate premium at this time? Do you try to use a trailing stop order? Or do you add a put option to it to create a married put trade? Now, we looked at the comparisons of those on Apple. If we had gone in as September 3rd at around 103.50, 103.05, and to where we were at September 28th, where the stock closed at 113.95. Well, today, before earnings, Apple's bouncing around at about 118, 117.75 or so. It's up about $4. If we would have got in originally to a position or opened any options trades on September 28th, if the stock was trading at 114. Okay, so what could we have done and what might we have done? Well, what I might have done is on September 28th, I may have looked to buy Apple at 113.95. I would have bought the March, it was 170 days out in time, 115 put at 805. My total invested would have been 122.20, but remember I'm guaranteed, even in the worst case scenario, with earnings coming out in about 3 hours, guaranteed an exit of 115. So my risk, same percentage ironically, but my risk is $7, $700 for 100 shares in one put, or 5.7%. See here our standard risk-reward profile of the radioactive trade, unlimited potential upside, and of course protection to the downside. Locked in, known, limited risk. Well, how about the calendar spread on September 28th? Want to get into the stock more cheaply? Well, again, we would have used the same put, bought the March 115 at 805. But let's say we sold that 28th of October slightly out of the money, 113 put, really at the money. Why at the money? Well, that's the highest time premium at the time at 295. Now, this put's inflated, by the way, because the earnings are coming up, and the October 28th series is going to be the most affected by the earnings coming out in about 3 hours. So your net debit now would only be 510, but that's 100% of what you're risking on the position, isn't it? Okay, you're risking the full 510. Now I'm risking $7 here, but you're risking 100%. You have a max profit of about 280. But again, what do we know about that max profit on the calendar put? If and only if Apple's trading right around 113, or no more than maybe 0.5% above or 0.5% below, we could expect a return of around 280 or 54.9% of your total net debit. But your risk is to the upside. The stock moves up in the direction that you thought. We took this screenshot this morning. It's at 117.79 after the market opened, and you can see we're going the wrong direction. Here's the stock. Here's your upper break even. This isn't really working out for us, and we have earnings coming up in 3 hours. And the stock falls back to 113, we're looking pretty good. If it gaps up to 120 or 125, we're looking terrible. Okay? So, again, that's just a view of probably you're right. Now someone commented in, it's like no one would do this before earnings. I agree. But this is one of the 3 common discussions that are brought up. And it's why are you guys opening this married put in the fashion you're doing instead of doing it this way, which is better, or doing it this way, which is better? And it's because it's not really better. All right? What about our in-the-money long strangle? Okay, well, same March 115 put at 805 on September 28th. And you could have bought a March 110 call, 4 points in the money or so for 915. Now this makes your total investment, call plus put, 1720 out of pocket. But because the strikes are 5 points apart, the most you could lose is 1220, but that's really 70.9%. This is not forcing an ideal size trade. This is giving us a wide gap to hit the upper or the lower break even. We really need something wild to happen at earnings release in the next 4 hours and at market open tomorrow to get any value out of this particular position. Oh, and Jim, thank you. I'm going to get to that in just one moment. Bear with me, Jim. Just hold on for another 5 minutes, and I'll answer your question directly. Okay? So there's our profit and loss of what an in-the-money long strangle would have looked like. All right. Now the last one, the long call. Apple at 113.95. We could buy to open. We would have bought to open the quote-unquote parity trade, which I've proven I don't think is a parity trade at all. But the 115 call was going for 655. So if you bought one call, you'd have a total investment, a total risk of $655 or 100% of what you invest in the trade. Now, I'm risking $700, remember, but that's only 5.7%. And as we know, the profit and loss chart for the married put and the long call look similar, but they're not the same trade. Okay, they are not the same trade because you're risking 100% of what you invested, and you run the risk of over trading, dumping too much money. If you did 2 contracts, your monetary at risk would be about $1,310. Okay? If you did 4, you'd be at $2,620. Okay, so that's the lie of leverage. Now, you've seen the screenshots this morning, today, going through it, looking at the most recent screenshots for the Apple positions if they were opened on September 28th. Was bouncing around, 118, 117.75, 117.54. So from where we would have got in at around 113.95, we got about a $3 or $4 gain in the underlying stock. So all of these quote-unquote bullish positions should be yielding a profit, correct? Not exactly. How do they look today? Let's go back to power options and show you exactly how all 3 positions stand prior to the earnings. All right, let me switch over there, and I'm going to switch over to the Apple comparison. There we go. All right, let's make sure that this comes up. There we go. All right, first line here is our long call. Remember, we bought to open the long call at 655. Right now, Apple is at 117.48. Okay, so it's up about $3.53 from where I would have purchased the stock at 113.95, or 3.1% gain, which is probably what we'd expect for an average gain on a trade or an underlying security without a catalyst or event. But if the market's just moving up gradually, 3.1% is a good expectation for a 20 to 30-day period, I think. Okay, but what happened to our long call? Bought in at 655. The long call currently has a value of 770. That is using midpoint. So we have a gain of $115 monetarily, or 17.6% on the long call. Okay, so we got a $115 profit on the long call since September 28th. How about that calendar put spread? Well, this is interesting, isn't it? We saw it moved against us, not in the sense that we're going to be obligated to buy shares of stock at 113, but our total debit was 510. Our original expected gain was about that 46%. But right now, we don't have the full $295 gain on the 113 put. It would cost us 77 cents to close that put because we still have earnings coming up, okay? And our put option has dropped from 805 to 583. So we have a gain of 219 on the put that we sold in our favor, but a loss of 223 in the put that we bought. So the calendar put spread is currently at a liquidation loss. Now, sure, if the stock stays up or it gaps up in price, you can say, well, that 77 is going to disappear and the put's going to expire worthless. But remember the structure of the calendar put. We're going into earnings here in about 3.5 hours or so. And again, if it gaps up in price to 122 or 125, you're going to be at a loss. Sure, your put goes to 0. You don't have to pay anything back. for that 113 put you sold, but you have no more positive delta and your long put is losing value also. Okay, so just with a 3% gain, your calendar put's at a loss. The long call is at a gain of $115 or $17.6%, and the calendar put is at a loss. What about the in-the-money long strangle? Buying the 115 put and the 110 call? Well, again, here we see it. We went up to 1073 on the call, which is only a gain of 158. The put dropped down to 583, so we have a loss of 223. These are real-world prices. If we would have opened these positions on September 28th, what are we seeing? The stock's moved up 3%. We're at a loss of about 80 cents on the in-the-money long strangle. Okay, it's losing value even though the stock has moved up. Why? Delta opposed. You need to see a 6, 7, really, I'm going to say an 8 to 10% gain in a 20 to 30-day period before the in-the-money long strangle starts to show a profit. Where? I have lost 223 on the long put, but I've gained the full 353 on the stock in the married put position, so I'm at a monetary gain of 131. That's only 1.1%. Keep that in mind. But the monetary gain here is more than that of the long call on a standard movement over a 27-day period of only 3%. And what happens today at earnings if the stock decides to have poor earnings and it gaps down to 110? Remember, we saw Apple fall to 90 a couple series ago, didn't we? There was a sudden drop in the price where it dropped down to about like $94, $95. What would happen in that case? This would be about a 70% loss, the long call. This would start to show maybe some gain on the put, but we would have a smaller monetary gain. The calendar put spread would be at a loss now to the downside. It would cross over again where we'd have a loss there. And the married put would have a loss, but it'd be only about 2 or 3%, maybe at about 300 or $3.40, $3.50 or so, where I'd lose probably at least 70% of the $6.55 we invested, closer to $4 or $5 on the long call. This would have a monetary loss as well. Might have a small gain at 9. It would probably have a small gain around $100 to $98. It'd be a small gain. But I could also structure the married put to show a small gain in both directions as well. So I just wanted to illustrate that. Best bang for your buck. Well, you can talk about leverage, but we know if the stock goes the other way, you're going to be losing 20 to 30% on your leverage positions. Monetary gain of a 3.1%, 4% movement, anywhere in that fashion, we typically see a larger monetary gain on the married put compared to the long call, definitely compared to the in-the-money long strangle, and still looking at a slight loss here on the calendar put spread. And as the stock moves up, we'll gain more on the long call, more on the married put, more on the in-the-money long strangle, and lose more on the calendar put spread. All right? These are the comparisons. Now, the question had come in earlier, if I wanted to mimic stock ownership, I wouldn't buy this sort of at-the-money 110 call. I would have bought a 90 call or more. All right, jot this down. Remember this. Married put right now, 3.1% gain on the stock since September 28th. We're showing a monetary gain of $131 or 1.1%. Okay? But I knew this was coming. I prepared for it. Okay, so let's take a look here. Rather than showing that in-the-money strangle comparison using the 110, which was right at the money, or the 115 put that I would have used to enter the married put to begin with, what if I would have bought a deeper in-the-money call to mimic stock ownership? So remember, on September 28th, with our stock trading at the time at 113.95, that's a terrible 3, I apologize, it looks like a skewed 2, right? But at 113.95, we would have bought our 115 put we used for the radioactive trade, because we've got to use a fair comparison, so that would have been 805 as we saw before. But what if I bought the March 90 call, which was $24 in the money essentially, had a delta of about 0.82 on September 28th and paid $24.75 for the position. Okay. My total investment would have been $32.80, half of what I had in the radioactive trade roughly. My maximum risk is $7.80, higher than I had on the radioactive trade, but it's also the lie of leverage, 23.8% of what I invested in the position. And what did you do? You increased the well. You increase the distance of the well of profitability. You now need a much larger movement to hit an upper or a lower break even. But that's okay because the stock moved up 3%, so the long call that was deeper in the money would have performed better than the 110 call because I had a better delta. Well, where do we stand right now? Do we have a gain by using the deeper in the money call with a delta closer to 1? Yeah, your call's at 27.73. You've got a gain of almost $3 on your long call. You're still losing the 223 on the put. So where are we at? We're at a gain of 75 cents, or what we'd call $75 for one contract. It's a profit because the deeper in the money call. I'm at a monetary gain of 131, almost double, a little less than double of where the in the money long strangle is monetarily. So what is the best bang for your buck? Is it having the controlled risk in place in first? And is it having the position with the limited risk trade and an unlimited upside? Or is it using leverage because you'll always do better as well? Okay. And Rodney just kind of showed that. All right. You asked, Rodney asked, between the long call and the RPM position, what if both positions had the same delta at the time of entry? This was actually, okay, here's why I'm not showing that, Rodney. I've done this example for several years. I looked at the option chain today for Apple. I picked this particular one, the March 90 call on September 28th, because it had a delta of 0.8. And you say, well, why didn't you go to the 85? Why didn't you go to the 80 where you would have had a delta of 1 or closer to 1, maybe 0.97? You know why I chose the 90? Because at that time, there was no recent activity and an open interest less than 2 contracts on things below the 90 strike call. Why is that important? Because everyone says, oh, you could buy a 75 call against Apple when it was at 114, and you would have only paid, let's say, $29, close to intrinsic value for it. Well, you could put in a bid and an ask, you could put in a limit order at 29, but with no recent activity and very little open interest on the position, you're going to fight against the market maker. He's not going to give you that intrinsic price where your delta is equal to 1. You're going to pay a little bit more than that. Okay, you're going to pay more if you even get filled on the position. The examples I've run for this over the years, we used to email PDFs on comparisons of IBM. When those comparisons came in about, well, just use a delta of 1. Realistically, if anyone has done this consistently in your account, if you've consistently bought calls and puts that were so deep in the money that the delta was as close to 1 as you could get with little to no open interest and little to no current volume, if you get filled on those positions regularly, email me in and let me know, because most of the time in the real trading world, I don't see investors get filled on positions they try to open if the delta is greater than maybe 0.92 or 0.95. And if they do, they get filled at a worse price because the only person they're trading against is the market maker because there's no real activity there. That's what I found. So that's why I used this particular option at the time on September 28th with a delta of around 0.8, 0.81 or so, close to a 1, because that would probably be the option I'd most realistically get filled on at a reasonable price. Everything else that was deeper in the money had such little activity and little open interest, I'd be fighting against the market maker. I would have gotten filled. I'd have gotten filled a little bit above intrinsic value, and yeah, maybe this gain here. I can tell you for sure, Rodney, if I'd have gone deeper in the money, if we would have gone to the 85 and got filled at a reasonable price with some small amount of time premium that we'd have to pay, we would see the profit right now go up. So this in the money long strangle at the 90 call with a 75-cent unrealized profit right now, if we had used the 85, we might see an $85 unrealized profit with the stock up 3%. If we did the 80 We might be closer to, let's say, $1 or maybe even $1.05 going to the deeper in the money 80 strike. And if I would have gone further, okay, maybe down to 75 or 70 and managed to get filled, we might be closer to that 110, maybe 120 gain where we're still having the 130 on the married put, okay? Oh, okay, Rodney, it doesn't work the way you expect, okay, because they're delta opposed. So Rodney says, okay, no. The RPM would have a delta of about 0.5 or 0.4. Excuse me, Rodney, you're right. So do a 0.4 delta long call. That's not how it works. Okay, Rodney, that's not how it works. Why? Okay, because I'm still using the same put that has a 0.55 delta. Okay, let's say my delta was 0.55 when I open this position with the 115 put. When I open the married put, we have to keep the 115 put, Rodney, to make it a fair comparison of what you would do with not entering a radioactive trade. Simple as that. So if my delta is 1, I've got a positive delta when I open the position at 0.45. Okay? Well, if I buy an out-of-the-money call, you just said, well, the RPM position would have a 0.4 delta, so do a 0.4 delta long call. We did that already. That was just the out-of-the-money long call by itself. If I enter an in-the-money long strangle with a delta of 0.4 for the call, I would have probably bought the 120 call. Okay, so now the stock has moved up. Remember, my delta is not 0.45. If my 120 delta on my call is 0.4, my delta for the in-the-money long strangle would be negative 0.15. So I have a 0.55 negative delta on the put and a 0.4 delta on the out-of-the-money call. So as the stock moves up, I'm losing more on the put than I'm gaining here. Your delta opposed still. It's still the same play. Your delta opposed. Yes, the delta is going to increase as it moves up, but so is this one. Okay, that's the delta opposed. It doesn't work that way. So we showed if I had bought the 115 call instead of the 115 put just as a parity trade in the married put versus just the long call, that delta of the 115 call is around 0.4. If I try to combine a delta of 0.4 on a call with my delta of negative 0.55 on a call, I'm still delta opposed. Not delta neutral, I'm delta opposed, and I'd still need a larger movement in the stock. That 120 call that we would have bought here for Apple probably only would have seen a gain of about $1.15 or $1.20. It would have been less than the long call, so we'd still be at a loss. Okay, Rodney, you're talking about a pure long call position, not a strangle. I already showed that. I'm sorry. I guess you missed it. That was one of the 3 comparisons we did. And it's here. The 115 call on September 28th, the quote-unquote true parity trade, would have had a delta of around 0.45 or so. Okay? Or if I went to the 120, the monetary gain would have been less, as it is with the long call. I get a better delta with the radioactive trade setup than I would using with an out-of-the-money long call. I know the percentage gain is higher, but I'm talking about the monetary gain and what we always see when we run these examples, Rodney, about what the position would look like. Okay? You wouldn't have a higher gain with a higher monetary gain with a deeper out-of-the-money long call in this scenario. Okay? That's the key. So we're looking at that gain of 131 here when we did the parity trade against the 115 call. Okay? All right. All right. So let's see here. That is what we wanted to illustrate today with the 3 comparisons regarding what is commonly asked. And these are the proper questions to ask. How do I know that? Because I ask the same questions. When I was first introduced to the radioactive trading techniques a few years back, of course 7 years back, I had been trading for already 8 or 9 years. I had done covered calls and saw about a 2.5% gain with a covered call strategy in a portfolio over an 18-month period. I'd done cash secured naked puts, about 2 years of calendar spreads in a portfolio, making different adjustments and more, as well as buying calls, buying puts, and doing straddles and strangles. And so when I saw the setup, I said, yeah, I'll get in a better position if I do it as a calendar put. I could do better if I treat it as an in-the-money long strangle with my portfolio because I was only trading with about $20,000 7 years ago, okay, or like $18,000. So I want to use leverage. or just buy the call outright. And what I found over time is that if I had set up in the first few months of trading radioactively and doing the comparisons, entering some calendar put spreads as I saw today, as we showed today, entering the in-the-money long strangles, the actual married put would have performed better in comparison to these quote-unquote parity trades 80%, 90% of the time on the positions that I opened. Okay, now sure, a couple times the in-the-money strangle looked better if the stock fell 15 to 20% in the first 40 days, which was way beyond what I was expecting to happen, and the in-the-money long strangle showed a gain where I was showing a loss on the married put. That happened, but only about 10 or 15% of the time for the number of trades that I opened. Okay, so that's why I feel the radioactive trade is superior. These are the proper questions to ask, which is why we host this webinar, so that you can see the comparisons, you can see real-world examples, and you can see why they do not perform the way you'd expect, and how each of those risks the lie of leverage and the potential for overtrading, because it don't force an ideal size trade. The first of the three components of any trading, not just radioactive trading, the three core principles: forcing an ideal size trade and proper position sizing. Those trade comparisons against the radioactive trade do not put you in that position. You run the risk of overtrading and falling in the trap of the lie of leverage, which many of you have traded credit spreads or even buying calls and puts or doing straddles and strangles have probably experienced over the years. I experienced it too. All right, so what to do next? Well, the only way to learn the full technique of the proper radioactive setup, described by what we look to set up, how you want to set up that initial trade, and the hows and whys of the 12 different income methods that you can use to lower that initial at-risk and potentially bulletproof trades, is to pick up the blueprint. Okay, it's over 250 pages detailing the initial radioactive setup, how to play it in a bearish market. You'll also get access to, of course, archived webinars for blueprint owners only and Fusion members only as well. There is a special chapter on combining income methods, and of course there's different appendices talking about how to choose the income methods, when to use which one, and a full chapter on each income method about what to look out for, how not to do it incorrectly. Now right now there's running several special bonus offers for the blueprint. If you go to radioactivetrading.com/iridium, oops, let's see here. Let me spell it right. Send it to you in the chat window here. There you go, radioactivetrading.com/iridium. You'll be advantaged to take of the 5 special bonus offers we have right now. Kurt put together something called a quick action guide, which is a little white paper that will help you get started radioactive trading more quickly. Kurt has put together 6 Mastery Series CDs, video webinars that are about 2 hours long, that's available in the home study kit, which contains the blueprint and the 6 CDs. But if you just pick up the blueprint, we'll send you the first of those 6 CDs for free, the Foundations of Radioactive Trading. You'll receive your first month of Fusion, where you can follow Ernie's radioactive trades, my radioactive trades, and Greg Renner's radioactive trades as well. And of course, see the full track records and historical trades as a learning tool. You also have access to Fusion lessons that Kurt put together and a basic RPM report to find new trades based on the rules in the blueprint. You'll get your first month of Fusion for only $10. It's usually $69 per month. That should say $59 in savings, not $79. So it's usually $69 per month, so it's a $59 discount. You also get a free month of power options that we looked at today, some of the profit and loss chart features, and of course the portfolio. We also have access to all the search tools. Picking up the blueprint, you'll get a free month of power options, and you'll also get a free session with either myself or Ernie to talk about the radioactive trading concepts of the blueprint or more. And of course the blueprint also comes with a money-back guarantee. If you pick up the blueprint today and you're not, for whatever reason, you go through the first couple of chapters when you receive it, you don't feel it's going to work out for you, you don't feel it's going to really what you were looking for, you don't feel that, you know, it's going to match your goals, well then just ship it back to us. We'll refund your money, no questions asked. Blueprint owners also get access to the Blueprint members only webinars, both the archived ones and the live webinars as well. We're probably doing a Blueprint owners only webinar on Thursday discussing which income methods I like to use heading into earnings or going into an earnings date on a protected position, or opening a new radioactive trade knowing that earnings are coming up in the next 2 weeks. We'll send an email out about that tomorrow for Thursday's presentation. All right. Well, ladies and gentlemen, if you have other questions, either what we discussed today or other trade comparisons, just remember, send me an email at any time to support@radioactivetrading.com. All right. You can also reach us during market hours. If you live inside the U.S., you can reach us at 877-992-7971. If you live outside the U.S., you can reach us internationally at 302-992-7971. I'd love to hear from you, but I'm actually not going to be available for about the next 15 to 20 minutes or so, but if you call later on this afternoon, I'll be more than happy to discuss things with you or answer any questions that you have. Well, ladies and gentlemen, thank you for joining me today. I hope you all have a great trading week.